The stock market is currently closed as today is Saturday, June 20, 2026, and Datavault AI Inc., trading under the ticker symbol DVLT on the NASDAQ, finished its last active session at exactly $0.4065, marking a modest intraday gain of nearly 1% on a volume of over 26 million shares. While a 40-cent stock usually signals a company on the brink of absolute collapse, the hidden reality here is that this microcap entity is currently holding $250 million in total liquidity, with an additional $140 million in pure working capital. This massive capital cushion completely contradicts the standard market expectation of an imminent bankruptcy filing. Most casual market observers looking at their mobile applications assume that any asset trading under 50 cents is a dying shell company, diluting its shares just to keep the lights on for another month. The actual numbers reveal a strange corporate paradox where the cash on hand and the short-term assets significantly outweigh the current equity valuation assigned by public trading markets. This massive mismatch between public perception and balance sheet strength creates a fascinating setup for individuals focusing on deep fundamental asset research. When most retail investors look for new opportunities through popular investing sites, the general consensus is to stick with massive corporate giants like Nvidia stock or look for stable growth names through tools like Schwab Intelligent Portfolios. The typical retail trader using a Robinhood app or managing a basic individual brokerage account treats sub-dollar assets as lottery tickets rather than actual business operations. The prevailing narrative around Datavault AI Inc. is that it is a highly speculative, volatile stock destined to fade into obscurity, especially after suffering a massive long-term drop from its historical peaks down to its current penny stock status. However, a contrarian analysis of the underlying numbers forces us to challenge this dismissive view. While the crowd treats this asset as a pure gamble, a closer examination of institutional filings on a professional platform shows a highly strategic accumulation phase by major holding groups and insider networks who currently control a substantial percentage of the outstanding shares. This implies that while retail market participants are fleeing due to short-term price volatility, sophisticated players are looking at a completely different timeline focused on infrastructure and asset monetization. Recent trading metrics reveal intense volatility and highly unusual volume patterns that deserve significant attention from anyone involved in online investing. The stock has been bouncing aggressively within a tight daily range between $0.38 and $0.42, yet the sheer volume of shares changing hands suggests massive accumulation or distribution happening behind the scenes. Traders utilizing a standard Fidelity trading platform or tracking active microcap movements through Fidelity Investments have noted that Datavault AI Inc. recently reported its first quarter earnings for 2026, catching the market off guard. The firm beat the consensus earnings per share forecast, coming in at -9 cents compared to the loss of 14 cents that Wall Street had widely anticipated. Despite this clear fundamental beat, the immediate market reaction was a sharp drop of over 14% as short-term traders rushed to exit their positions. This classic post-earnings dip highlights the intense friction between short-term technical selling and long-term asset positioning, a pattern frequently observed by individuals managing active accounts on the Interactive Brokers platform. This sharp divergence between earnings performance and immediate price action is largely driven by the broader macroeconomic pressures affecting small-cap technology equities. With institutional rates remaining restrictive, speculative capital has largely abandoned microcap entities in favor of megacap tech giants, which explains why so many portfolios are heavily weighted toward traditional choices like Apple stock. When retail investors look for investment help to build a self-investing strategy, automated services like a SoFi robo-advisor or standard intelligent portfolio algorithms automatically filter out any asset trading below a certain market capitalization or share price. This systematic exclusion removes a massive pool of natural institutional buyers, leaving the stock price entirely dependent on retail flows and private placement dynamics. For traders who execute orders through Interactive Broker stock trading, the low nominal share price creates massive percentage swings on tiny absolute price movements, attracting high-frequency scalpers who care nothing about the core business model but drastically inflate the daily trading volume. Understanding what Datavault AI Inc. actually does requires moving past the simple stock chart and looking directly at their modern corporate structure. The company operates at the intersection of Web3 architectures, cloud-based data experiences, and advanced asset monetization, utilizing a double-pronged approach through its specialized acoustic science and data science divisions. Following a comprehensive corporate restructuring and an official name change in early 2025, the management team has shifted its focus heavily toward tokenomics and proprietary data valuation systems. Long-term records available through comprehensive research tools like Fidelity Wealth Management show that the firm has spent years building a complex patent portfolio designed to protect its data security methodologies. This business model relies on turning raw corporate data assets into liquid, tradable tokens, a strategy that could yield massive margins if corporate adoption scales, but remains highly dependent on shifting regulatory frameworks. The future outlook for this asset depends entirely on a few critical catalysts that could either validate the current bullish insider accumulation or confirm the fears of the bears. The most critical factor is the upcoming legislative clarity regarding digital asset tokenization, specifically the pending regulatory guidelines that the executive team highlighted during their recent earnings call. Furthermore, the company is attempting an aggressive expansion strategy targeting 100 distinct metropolitan regions, while simultaneously working to integrate its recent corporate acquisitions, including the platforms developed by NYIAX and Cybercatch. If the management team successfully executes this integration and taps into their projected $200 million full-year revenue projection, the stock could experience an aggressive upward re-rating toward the historical targets maintained by institutional analysts. Conversely, if the integration fails or the rollout faces technical delays, the cash burn rate will accelerate, threatening their existing capital reserves and forcing further dilutive private placements. Comment below how many shares of Datavault AI Inc. you currently hold in your personal portfolio, or let me know if you prefer keeping your capital allocated to large blue-chip names like Tesla stock. Watching how retail investors distribute their funds across various platforms, whether they are buying fractional shares on a Robinhood stock trading account or investing in diversified Fidelity ETFs, shows a clear divide in risk tolerance. Those who allocate capital through standard SoFi investing accounts often seek out these high-variance assets for asymmetric upside, whereas conservative investors utilizing institutional services like Fidelity Iris or managing long-term capital through Fidelity mutual funds tend to avoid sub-dollar equities entirely due to the extreme compliance and volatility risks involved. Tracking these retail distribution trends gives us a clearer picture of market sentiment and helps explain why small changes in retail momentum can cause such massive swings in microcap valuations. In summary, the central insight surrounding Datavault AI Inc. is the extreme gap between what the broader market expects and what the corporate reality presents. The market looks at the 40-cent share price and sees a failing corporate experiment, expecting it to slowly drift toward zero while retail traders move their online investment capital into safer alternatives on the SoFi trading platform or use the Fidelity mobile app to purchase stable index runs. The reality, however, is a company sitting on a massive $250 million liquidity pile with an active patent portfolio, accelerating quarterly revenues, and sophisticated insider backing that suggests the underlying business is far from dead. Navigating an asset with this level of complexity requires moving past superficial price trends and conducting rigorous individual brokerage analysis. Whether this balance sheet strength eventually forces a massive short squeeze or the operational risks overwhelm their cash reserves remains the key question, but for now, the data shows an asset that refuses to conform to standard market expectations.